Good afternoon, students. Today we will be studying capital budgeting, and the method we will be studying is internal rate of return. So let's start. The internal rate of return. This internal rate of return is a modern method of capital budgeting. In this method, we try to analyze the discount rate at which the NPV will be equal to 0. We know the formula of NPV. Yes, NPV is equal to present value of the cash inflows minus present value of the cash outflows. So, in while finding the present value, we need a discounting rate, right? We need a discounting rate. So, we will try to analyze the discount rate in IRR method when this NPV will be equal to 0. Yes. So mainly we try to analyze in the IRR method when the discount rate at which NPV will be equal to 0. Understood? Now coming to the investment rule of IRR. Okay, when we will accept a project, when we will reject a project using the IRR method. So we will be accepting a project if the IRR of the profit project turns out to be greater than the cost of capital. Yes, when the IRR will be greater than the cost of capital, we will be accepting that project. Yes, but if the IRR of the project turns out to be less than the rate cost of capital, then we will be rejecting that project. We will be rejecting it. Understood? So this is the decision rule. How we will be seeing that whether to accept a project or reject a project. Yes. Now see, we will have to calculate the NPV, right? So first what we will be doing when we are being given a question, we will first try to analyze by taking a discount rate. At that discount rate we will be assuming, okay, we will be assuming it. Let's say we have first taken at the rate of 12% as the discount rate to find the NPV of a project. Okay, if the NPV of the project turns out to be negative, if the NPV of the project turns out to be negative, that means we get a negative value, then what we will be doing, the next discount rate which we will be taking will we will be calculating at a lower rate than the rate which we have taken to calculate the previous NPV. This time we will be taking a lower rate. Understood? So here that means while calculating the IRR we need two discounting rates so that we can calculate the rate at which NPV will be equal to 0. For doing that, we will have to use trial and error method. Which is also known as interpolation. Through interpolation, we will be finding the IRR. Okay. So for that, as we need two discounting rate, we will be assuming first any discount rate. Yes, we will be taking 12%. Okay, if the NPV of the project turns out to be negative, what we will be doing, the next rate which we will be taking as a lower rate. Say we will be taking 10% then. Okay, if the and then what we will be doing, this is the higher rate and this is the lower rate. So what is the formula for finding out the IRR? That is lower rate plus NPV of the lower rate divided by NPV of the lower rate minus NPV of the higher rate. Yes, of the higher rate. Then multiply it by higher rate minus lower rate. Yes, let me write it nicely. So what we will be doing, how we will be finding the IRR? that is the lower rate, yes, plus NPV of the lower rate. Then we will be dividing the NPV of the lower rate minus NPV of the higher rate. Okay, and then multiply it with the higher minus the lower rate. Understood? So let me again make it clear. See how we'll be calculating. First we will be taking two different discount rates. Okay, two different discount rate. We will be first assuming any one discount rate. Say we have taken the discounting rate as 10%. Okay, say this time our NPV of the project turns out to be positive. Yes, it turns out to be positive. So what we will be doing, as we are taking as we are doing a trial and error method, we will be taking this time if it comes out to be positive, we will be taking this time a higher rate of discount rate. We will be taking higher rate of discount rate, say 15% we have taken. Yes, then our NPV will be, say it comes out to be negative. Okay, now we can find the IRR here, or it may come out to be positive also. That's not the case. The case is that first what we will have to see that the discount rate which we will be taking, if the NPV, the first discount rate which we have taken, it turns out to be positive, the other discount rate we will be taking is the higher discount rate than the one we have taken. Okay, but if it turns out to be negative at the first time only, then we will be taking a lower value in the second time, lower discount rate we will be taking. Okay, right, lower rate we will be taking while finding the next time, the NPV which we will be finding the next time. Yes, for that we will be taking a lower rate if it turns out to be negative the first time. Understood? So now, and then we will be using the formula to find the IRR, that is the lower rate plus the NPV of the lower rate divided by the NPV of the lower rate minus NPV of the higher rate into higher rate minus lower rate. Clear? So I hope this formula is clear. So now let's move to a question. Let us now see this question. Calculate the internal rate of return of an investment whose initial investment was 1,40,000 and you have been given with the yields. Yes, in here you can see that the discount rate has not been given. So in here in this question we will have to assume the discount rate. Yes, for finding the present value of the cash inflow. So let us assume the discount rate at the rate of 10%. So we will have to find the present value factor at the rate of 10%. And we know how to calculate the 10%, as 1 divided by 1.10 to the power 1. Yes, and then for the second year again 1.10 to the power 2. This way we will be finding out the present value factor. And the answer comes out to be 0.909, then 0.826, yes, then 0.751, and then 0.683, then 0.621. Yes, once the present value factor has been, we find it out, we will have to multiply the cash flow with the present value factor in order to get the present value of the cash inflow. Yes, so it comes out to 40,000 to 0.909. It comes out to be 36,360. Okay, the next year it is 24,780. Yes, the third year it comes out to be 4,50,000. Okay, it comes out to 4,50,000. This time it's higher, 4,50,060. Sorry. Okay, it should be here. Then in the fourth year it comes out to be 20,490. Yes, and in the fifth year it comes out to be 12,420. Yes, so we'll be adding it up, and we'll be getting 1,39,110. Yes, So now we can find out the NPV here for the discounting rate at the rate of 10%. So NPV is equal to present value of the cash inflow minus present value of the cash outflow. Yes, and how much we will be getting? 1,39,110 minus the investment which we have done already, it is 1,40,000. So we can say from these figures that our NPV will be negative, and it comes out to be 890. Yes, so it's negative. So once it is negative, we know that we will have to take this time a lower discount rate. A lower discount rate. Why we will have to take a lower discount rate? Because our NPV have come out to be negative. Yes, and as is a trial and error method, we will have to keep on trying till our NPV is equal to 0. Yes, comes out to be 0 at the rate at which it will be 0. So now we will be taking a lower discount rate. Understood why we have taken a lower discount rate? Because our NPV has come out to be negative. So this time let us take it as 8%. So while finding the present value factor at the rate of 8%, again we will be using this formula as 1 divided by 1.08 to the power n. The number of years, if for first year it will be 1, then for second year it will be 2, then for third year it will be 3, yes, and so on. This we will be calculating. And what we will be getting at is 0.925 for the first year, yes. For the second year, we'll be getting 0.857. For the third year, it will be 0.794. For the fourth year, it will be 0.735. And for the fifth year, it will be 0.681. Yes, once we have calculated the present value factor, now we will have to multiply with the cash inflow. Cash inflow into present value factor. That is 40,000 into 0.95 to find out the present value of the cash inflow. Yes, so we'll be getting this 40,000 is 0.925. It will be 37,000 for the first year. For the second year, it comes out to 25,710. For the third year, it will be 47,640. And for the fourth year, it will be 22,050. And for the fifth year it will be 13,620. And once it is done, we'll be adding it up and we'll be getting 1,46,020. Yes, so now we can calculate the NPV while taking the discounting factor at the rate of 8%. It comes out to be 1,46,000, that is the inflow, minus the present value of the cash outflow, it is 1,40,000, and we can say from the figure that we will get a positive NPV, and we have got it as 6,020. Yes, now what we will finding, we will have to find out the IRR. Yes, to find out the IRR, we will be using the formula, and our formula is lower discounting rate, yes, plus bracket NPV of the lower discounting rate, then NPV of the lower discount divided by NPV of the lower discounting rate minus NPV of the higher discounting rate. Yes, multiply with the higher discounting rate minus the lower discounting rate. Yes, the formula is clear. So now we know our discounting rate, lower discounting rate was 8% plus NPV of the lower discounting rate we have got as 890. Yes, we have got it as 890. Now 890 we have got, sorry, it is not the lower discounting rate, we have taken the higher discounting rate, right? So we will have to take the lower NPV, lower discounting rate NPV. So it comes out to be it was 6,020. Yes, it was 6,020. because we have to take here the lower, and lower was 8%, right? While taking 8% discount rate, we have got an NPV of 6020. Now 6020 minus the NPV of the higher discounting rate, that is 890. Yes, that is minus 890. Yes, into higher discounting rate is 10% again, and then it is 8% lower discounting rate. Yes, so while calculating it, 6020, say now 6020 minus, again there is a minus sign, so it will minus minus, it will become plus, so we will be adding it up and we will be getting 6910. Yes, into 2%, that is a 2. Okay, so now we will be multiplying the 6020 into 2. We will be getting whatever amount we are getting, that is 12,040 we will be getting. Okay, then we will be dividing by 6910 and we will be getting 1.74. Yes, so we have got the IRR, that is 9.74 will be our discounting rate, at which 9.74 it is. Okay, we will be getting our NPV as 0. So when we will be finding out this cash inflows by using the factor as at the rate of 9.74%, then we will be getting present value of the cash inflow. Okay, present value of the cash inflow will be equal to the 1,40,000. That is the present value of the cash outflow. Only then our NPV will be equal to 0. So at what rate NPV will be 0? We have got the IRR as 9.74. At this rate, if we find out the cash inflows, present value of the cash inflow, it will be equal to the present value of the cash outflow. And when we deduct it, we will be getting 0 as our answer, right? So we have find out with the IRR, the discounting rate, with the IRR formula, right? I hope it is clear. So now let us move to the disadvantages of IRR. So before seeing the disadvantages of IRR, let us see that which method supersedes, whether NPV method supersedes or in the IRR method supersedes, between, while we need to choose a mutually exclusive project. Mutually exclusive project. What does it mean, mutually exclusive projects? It means that, let us say we have two projects, project A and project B. Okay, project A is for hotel construction and project B is for cinema hall construction. Okay, we want to construct cinema hall. So in this case we have to choose any one of this because we have a particular piece of land. Yes, so what we will try to analyze, we will try to analyze the most beneficial project. So for that we have calculated the NPV, say, and NPV comes out to be 1000, and project B, it comes out to be 1500. Yes, and when we calculated the IRR through the IRR method, our rate of return comes out to be 8%, and in here it comes out to be 7%, project B. So if we see the IRR criteria, we select the one with the higher NPV, higher IRR. Yes, so project A will be chosen if we go through IRR method. Project A will be chosen through IRR method. Yes, but when we see through the NPV method, the project with a higher NPV will be chosen. So through the NPV method, project B will be chosen. Yes, so now we need to take a decision in which project we want to invest. Both are coming. A's project is also selected through IRR method, project B is selected through NPV method. So in this case, NPV method supersedes the IRR method. NPV method supersedes the IRR method because it helps us to find out the exact amount which will be the by which the value of the farm will increase. Yes, by doing an investment. So we will be selecting to set up a cinema hall. Okay, because our NPV comes out to be 1500, which is greater than 1000 of project A. Understood? Yes, now let us move to the disadvantages of IRR. Disadvantages of IRR. First one, it says that economies of scale is ignored. Economies of scale means, let us see an example. Say our project value is, we have 1 lakh, okay, and our rate of return which we will be getting is say 18%, okay. So we can say we have a benefit of 1,80,000 from the investment, and we have another project that cost 10,000 and the rate of return is say 50%. 50% we are getting return, yes, and it comes out to be 5,000 the profit. But in here, if we see the take the IRR method into consideration, we will be taking the project, investing in the project which have a higher rate of return, yes, higher IRR. So higher IRR is in project B, yes. So project B will be chosen as it has a rate of return as of 50%. But if we see the profit, overall profit, yes, our project A is more, yes. So these economies of scale, that is 1 lakh is more than this 10,000, right? The investment amount, which it will not be taken into consideration. See, if we see take the IRR method into consideration, our project B will be chosen, but that is not the case. Project A is more profitable than project B. So this is a disadvantage of IRR method. The next is that mutually exclusive projects are ignored. Mutually exclusive project, already I have said that, say project A. Of project A, we first what we do, we try to take a discounting factor, say at 15%. If the NPV comes out to be negative, we take it comes out to be negative, we take a lower discounting rate, say 10%. Of that particular project only. We do not try to compare between this A project or B project which we may have. Of course, we are in business, always there is an alternative, but that is not taken into consideration in IRR. So mutually exclusive projects are ignored. We do not try to compare between projects. We take a project and then we try to find out the discounting rate at which NPV will be 0. I hope it is clear. Okay. Now see the next method, next disadvantage, which is different terms of the projects are ignored. That means if a project A has 5 years, okay, project B is for 2 years, and the rate of return is say of this is 10%, of this is say it is of rate of return here is 8%. In here the we will be selecting the through IRR method, we'll be selecting the project with a higher rate of return, right? The higher IRR, that is project A will be chosen. But in here you see the time period is also more. Here in B project, what we can do, the return which we will be getting with 8%, we can again reinvest it. Yes, this reinvestment criteria is not taken into consideration in the IRR. That means the different terms of the project are not taken. Say if we reinvest this, the profit which we will be getting by investing in this project, yes, we can earn a more at that time. Yes, but that criteria is not being taken into consideration. That means the time period is ignored. Yes, it is ignored. Understood? Now the next is a dependent on the contingent projects. Dependent or contingent projects are ignored. Dependent or contingent projects means, say I have a project. I want to invest in a project, say in a transport business project. Okay, transportation of vehicle. Transportation of vehicle. Okay, so I want to invest in this project. If I want to invest in the business of transportation of vehicle, so in order to park this vehicle, I will again need a plot of land. Yes, I'm going to need a plot of land for parking purpose. Yes, if I only see through the IRR method, I see that the investing in the transportation of vehicle is very profitable for us, for me, and it comes out to be the rate of return from this project. It comes out to be, say, by investing in transportation of a vehicle, it comes out to be 15%, and it is very profitable for me. Okay, but while taking this land, parking land, for parking purpose, the land which I need to take, again the maintenance charges will be there. it comes out to be 20%. Yes, the cost I will have to bear is 20%. Okay, that means the expense is more than the return I will getting by investing in this project of transportation of vehicle. Yes, that these criteria is not seen. That means the contingent projects are not seen. If I want to indulge in the transportation of vehicle, I also need a parking lot for that, and the parking lot maintain expense, it, expense is way high than the profit I'm earning from this business. These criteria, this thing is ignored by the IRR method. We only see the return from the investing in the transportation of vehicle. We do not see the parking expenses, the maintenance expenses which we will have to incur if we indulge in the business of transportation of vehicle. I hope it is clear. So these are the disadvantages of IRR. There are some advantages also that IRR method, it helps us to know the exact value at which the NPV will be equal to 0. Yes, and also this method take into consideration the time value of money criteria. I hope you all have understood it, and if there is any doubt, please ask me. Okay, you can ask me by calling me or by messaging me. Yes, thank you.